Good morning, everybody. Let's get going, I think. So I've got one of the news this week. Richard's got another one. So we'll cover those first. And then I'm going to be talking to Tim Levine of Augmented FinTech. So news. So the thing I wanted to look at was Atrato Onite Energy. There's not a lot of news this week, to be honest. Nothing very big investment company sector. I think the LXI thing is much bigger. But Atrato published some results, and I thought it might be worth having a look at that. That is the chart of it since it launched. And you can see that in common with many other renewable energy funds, it would move to trade at a discount last year. And that discount has sort of got a bit wider. So it's now about 23%. And it's not very big, so about 107 million. And that's more obvious when you look at this chart of the whole sector, where I've ranked it by market cap. And you can see that the three bottom ones are all now decided to give up one way or another. So they've called it strategic reviews or in wind up mode already, or their fate is being decided. Hydrogen One Capital Growth, I'm still convinced is going to come back and be a great success in the long run, but it needs time. And US Solar obviously flirted with winding itself up and decided not to do that and plow on. So Atrato's in that sort of area, the kind of zone where people might be questioning its future. So I think it's probably worth a closer look of how it's been doing. It launched in November 21, so it's only just over 2 years old. It raised 150 million, which is the most that it wanted. And the plan was to get that money deployed within 12 months. However, by the time we get to the end of September 22, the actual amount invested was just 49 million quid. And so it's no great surprise that because they've been promising to pay dividends from launch, so an annualized 5p, which works out at 4.27 for the initial period, they were not covered by revenue. In fact, the revenue for that first initial period was negative, almost a penny. And so that was a big hit to the NAV. So effectively, people put up the money, put up £1, and just got handed 4.27p of that back without really achieving very much. At the same time, because interest rates were rising, they had to adjust the valuations. And so that drove down the NAV. So that meant that the end September NAV was 92.8p for September 22. So in the year that's just been just finished and they've just reported on, they'd invested another 72 million quid, but most of that wasn't operational either. And so the net revenue was still quite paltry, still 1.82p. They declared 5p dividends, so no increase in the previous year. But obviously most of that was coming up capital again. And the cash dividend cover was only 15%. Unfortunately, because rates carried on going up, the NAV fell again. But one way or another, it worked out 92p. And the reason it didn't fall that much, you can see here, because they had this policy from the beginning of investing in things that were in sort of installation phase, not yet operational, and then they were able to write those up. And that happened in the first year too. And you can see the effect of that in the year to set in this 2023's 10p uplift, offset by this 7.7p drop from the discount rate going up. Now, obviously, what we'd like to see, and it may happen, is that now the rates have peaked and the long-term borrowing costs for government are falling, it may be that discount rates come back down again. I don't think that's going to happen too fast. It's one of these things that we just got to wait and see how that pans out. But I do think that this element of it, which you've seen 2 years running now, is probably done. So that's one bit of good news, maybe. And they've been busy since. So in October, they announced quite a big acquisition for them, 77 million quid, which is a portfolio of residential rooftop solar. And that took the whole portfolio up to about 182 megawatts. It's now fully invested. It's still got some of that under installation, but they expect to do that, get it finished by the end of March. What makes this stand out is that most of the revenue is contracted under power purchase agreements, PPA, or subsidies. There's quite a lot of subsidies, especially in this residential rooftop portfolio, which has got a lot of feed-in tariffs in it. And it's contracted for quite a long term, so an average of 11 years. And also, it's got a lot of inflation linkage in there. Some of it's capped, but almost half of it is uncapped. So positive inflation is obviously helpful. And you can see that graphically here in terms of how it's been progressing. So this is the position obviously end of September. Fast forward to the end of March, and they reckon it's probably going to be operational. Or you can see it broken down by the different counterparties here, the different projects that they've bought. So they've got an ongoing program with Tesco that they putting rooftop solar on their stores. And then they've got some other ones here, and the one that's not yet operational is OVO, and I'll talk a bit more about that now. So I think one of the things that confused me at the beginning, given the name Roof and the sort of tie-up with Supermarket Income REIT, I kind of expected that it was all going to be sort of like rooftop solar on top of supermarkets. And that definitely didn't turn out to be the case at all. In fact, what they were trying to do was a lot of what they call behind the meter stuff, which basically means that you've got the generation, which is in this case is the solar, and that's got a wire that goes straight to the customer, and it doesn't go into the electricity doesn't go into the grid and back out again. And that was the kind of main plan. So things with Britvic and Nissan, the idea is that they've got solar panels in a field. But with the Nissan case, that was on the field next to the Nissan building, so they can just sell the power straight in. In Britvic's case, that is a solar farm that's in Northamptonshire, and they're just selling the energy into the grid, and then they've got an arrangement to sell the energy back onto Britvic again. That's on a 10-year fixed price PPA, so although it's something a bit different from your portfolio, it is still sort of adds up. The thing they've done with OVO is much closer to what the other solar funds are doing. So they've got a project in North Yorkshire that's 50 megawatts, and they bought from Harmony Energy, and it's supposed to be energized in Q2 24, but obviously from the charts we've seen before, they brought that forward a bit. And they're selling the energy there under a 3-year PPA to OVO with fixed annual uplifts. But it's a front meter project. Obviously, it's not going straight into the customer. It's going into OVO's kind of network of customers. And when that 3 years is up, it's just going to be selling power into the grid on a kind of merchant basis, unless they can secure a new power purchase agreement. So to me, this seems not what they were supposed to sort of set up to do. And therefore, I think it might be really kind of non-core. That's good news, because if they can sell it, there does seem to be a market for these things. If they can sell it for a profit, that would be good news, and it will help fund their pipeline. So going forward now, they've got dividend target of 5.5p, so 10% uplift. And crucially, they're saying that for the year ending September 24, they think it's going to be covered 1.4 times. They've got some room on their credit facility, but that's just paying a margin over SONIA, so a margin over the kind of normal kind of bank rate, which is obviously fairly expensive, so they don't really probably want to do that too much. But it's useful. In the good old days, you basically run up your credit facility up to the max, and then you'd raise more equity and pay that down. And I think that's what they'd like to get back to. And they've got a fairly chunky pipeline. So of which 61 million is kind of near term. So they can't afford to do all of that, which is why I was thinking that maybe selling that OVO thing might make sense, and they could do it that way. So I think it's interesting. It's kind of got a future. Sorry, but I think it's still quite small. And unless they can sort of demonstrate that there's a chance to grow it, I think people will be wondering whether they should just be absorbed by somebody else. Because, as I say, it's not 100% what they set out to do. It's still trading at a discount, and they haven't had a brilliant track record of deploying the stuff on a timely basis. It's obviously a different animal now that it's fully invested, but nevertheless, I think there is a question mark over it. So we're just going to have to wait and see what happens. Right, that's me. I'm going to hand over to Richard.
James? Yes. So the proposed merger of LondonMetric and LXI, which was announced just before Christmas, that has now been recommended by both boards. That was announced yesterday morning. So I thought we'd go through it in a bit more detail. So LXI shareholders will get 0.55 new LondonMetric shares, which values LXI at just under 2 billion, which is a 13% premium to their 1 month average share price before they made the announcement in December, but a small discount to their NAV. Now it will create a 4.1 billion company, which would be the 4th largest REIT, which is good. We need more large REITs, so that would be good. And it will be internally managed by LondonMetric, which is another tick for me. We had them on the show a few weeks ago, Andrew Jones, very impressive guy and knows what he's doing. So and internally managed, that's always a tick for us. They'd have to pay the LXI advisors 26 million, which seems quite a lot, and that could go up to 30 million based on sort of performance and things. But I spoke to Andrew yesterday, and he reckons they can save around 11 million a year on the management fees. So we're talking what, 2.5 years, less than 2.5 years to sort of claw that back. Nick Leslaw, which is another sort of property sort of heavyweight, if you like, big name in the property world. He's originally from Secure Income REIT, ran that for years successfully. That merged with LXI a couple of years ago, and he stayed on with them. He's going to join the LondonMetric board, which I think also shows some sort of continuity as well. Like I said, cost synergies involved in this are great. The EPRA cost ratios target is going to be sort of 7 to 8% in the medium term, which is very low, so that's good. And it will mean that they can grow their earnings faster and have their dividend progression, which is a massive thing for LondonMetric. They've done 9 years, well on the way to 10 years of consecutive dividend growth, and they really focus on that. So let's go into sort of detail about the portfolio. So I was a bit surprised when it was announced. I know LondonMetric were on the hunt for M&A. I didn't see LXI just because of the differences of the portfolios. You can see there on the 2 on the right. So LondonMetric, not famously, but are focused on logistics. Used to have a massive, this was way before logistics blew up. They were focused more on retail. He saw the writing on the wall for that before it happened, sold all that, got into logistics, and did very well out of it. Has recently been pivoting again towards more urban logistics, which are the smaller stuff close to town centres and city centres, last mile type stuff where the rental growth really is strong. And they started to build up a sort of long income portfolio, mainly from sort of convenience retail. And that is the bit that's sort of got the synergy with LXI. They've got as the name suggests, long indexed income, LXI. So they're focused on long income, triple net leased, which means that the tenant takes on all of the costs basically. But apart from that, the synergies weren't great. So the new portfolio is going to look like that on the left, still be sort of tilted towards logistics and convenience, but they're bringing on sort of massive healthcare portfolio and leisure, which is mainly sort of Merlin, which is Alton Towers and things like that. I expect to see quite a few sales from the LXI portfolio going forward. And Andrew did allude to that yesterday in that analyst briefing. Obviously didn't say which ones, but we'll wait and see on that. But on the next slide, we'll look at the sort of income. So top 10 tenants, so the top 2 there, Ramsay Healthcare, that's a big healthcare portfolio. That's pretty. That was originally from the secure income REIT portfolio. That's pretty sound. Then you see Merlin there, which is the theme parks, and Travelodge, which LXI have actually agreed to sell a big chunk of that portfolio, which is going to go through in the next few weeks. So that should drop down. And then on the right there, you see the top 6 assets, the top 2, obviously the LXI ones, and then you've got the logistics ones there, and then Thorpe Park at the bottom. So I expect some, maybe, well, I don't know. This is me looking forward and guessing, but I just don't see how the Thorpe Park and Walton Towers can fit in with the portfolio and LondonMetric sort of history. So we'll see with that, but they could be selling that in a rising market, so that could be good news. On the next slide, we've got a bit more detail on the income, but you can see the differences there between the 2 companies and how they look after. What I would pick out there is the fixed income, fixed uplifts, which will be 80%, is 60% at the moment, or 59% with LondonMetric. So that's probably a bit higher than they'd like. They more like, they like the fixed nature of it, knowing that it is going up, which is obviously good, but then they may miss out on the market uplifts, which could be higher, especially with interest rate inflation going down next year. It may not. So yeah, expect to see maybe some of that changing. But yeah, 99% occupancy, which is good. And then yeah, long income, which is also good. And then the debt. So what they've done prior to yesterday, so they've agreed to take on £700 million of new debt, which is unsecured. That will replace 625 million of LXI debt, which is secured over some of their assets, and that leaves them with an LTV of 31%, which is comfortable. That's obviously following the Travelodge sale and that paying off some of the debt. So 2.8 billion of total debt, 740 undrawn, so that gives them some sort of benefits in buying assets going forward. 3.9% average cost and 6-year maturity on that. So capital structure wise is strong. So yeah, just to sort of sum up really, triple net lease business, that means obviously the tenant takes on most of the costs. So the gross to net income ratio is very high, 99%, which is good. The active management of LondonMetric, they've sort of bought, we discussed it a few months ago, they bought CT property a couple of years ago. They bought another REIT, which they sold sort of 40% from that. They started to sell from CT property. So that they do sell and buy. That's what they do. They don't have any sort of emotional attachment to any of their assets. If it's not hitting the return profile, it will get sold, and I can see that happening a lot now. And they want to buy. They see a lot of buying opportunities coming up, especially with debt financing coming up, things like that. They see a lot of opportunities for good prospects. So and they see now having a bigger scale that they'll have a lot more of these opportunities. So there's a shareholder meeting to vote this through in February, end of Feb, and they anticipate completion in March if obviously that gets through, and I'm sure it will, because there's a lot of benefits to this merger.
Great, thanks, Richard. So that's the end of our bit.